Okay, ladies and gentlemen, thank you again for coming to Lunch and Learn. We're going to start our program very soon. I hope everybody enjoyed meeting Bear last time we were here. Did all of you get a chance to meet the dog, the canine? Yeah. Just be careful of your food when the dog is around. He'll steal anything he gets his hands on or his paw on. I also wanted to make a brief announcement. The police department is preparing to make 2 promotions, and promotion time at the police department is a big deal. We're dealing with these officers' careers and their lives, and we are about to promote a lieutenant and a sergeant, and it may be people that you know. So Sergeant Burke is going to be promoted to lieutenant, and does everybody know PJ? PJ Szynski, I think I pronounced that right. He's getting promoted to sergeant. So, no, he's not retiring for another year or 2. So, yeah, he's got long-term goals, but in the meantime, I'm going to use him as a supervisor, and he's going to be training up some of the young officers. So that's all good news. And now, I have to grab my paper. I would like to introduce to you our guest from the AARP. His name is Steve Lotterman, and he's from the AARP, and he's going to talk to us a little bit about filing taxes and the senior circuit breaker credit, which I don't know anything about. So, Steve, I'm going to turn it over to you. Thank you very much for coming.
Good afternoon, everybody. Who's going to watch the game? Who's going to watch the Super Bowl? What time is the game? Who's going to win? My name is Steve Lotterman, like a Letterman with an O. David Letterman put me on the map. Nobody could spell my last name until he came on TV, and I said, Lotterman is like Letterman with an O. I've been doing AARP taxes for over 5 years. Did VITA taxes for a few years before that, so I've got a little bit of experience, but there's always a question that somebody asks that you're not sure of. So what I'm going to try to do is give you some tax tips, perhaps some tax planning if you haven't done it already, for filing for tax year of 2018. As you know, there was a new tax law that went through a year ago, and created some hullabaloo with everybody, and the returns will look a little bit different this year than they did last year. So we'll talk about a little bit about tax planning, a little bit about the new tax laws, some tax documents that you need, and especially the senior circuit breaker for those of you who are old enough. You have to be 65. So when you're doing tax planning, what you're trying to do is to maximize your tax refund so that at tax time, typically you're trying to owe no taxes or receive no refund. And when you're working, you kind of can adjust that by how much you're having withheld from your taxes, from your payroll each week. So you can kind of adjust that. But nobody really kind of does that because everybody looks at having a tax refund as a little bit of a savings plan. So the way you can try to get the biggest refund is to make sure you list all of your dependents, all of your child care expenses, if you have any. There are grandparents who could have, no, grandparents can't do that. You have to be working in order to get the child care dependent credit. So what you want to do is keep track of all your qualified expenses and get all of the tax credits that you're eligible for. Child tax credit, could be earned income credit, education credits, and especially the senior circuit breaker credit. Some of you may be paying estimated taxes during the tax year because you may not have enough withheld from your taxes, your pensions, or your IRAs during the year. So occasionally people will send in estimated taxes on a quarterly basis, and they'll use forms to mail in their estimated taxes along with their payment. So most of you are familiar with withholding taxes. So taxpayers have to pay as you go. So if you're working, that's why they withhold payroll taxes from your paycheck, because you have to pay as long as you're earning. You have to pay as you go. If there's nothing withheld, then you have to do estimated taxes and do those quarterly payments. So usually when you start working, your employer will give you a W-4 form, and that's where you fill in your name and how many dependents you want to claim. And the more you claim, the less they take out. The fewer you claim, the more they take out. So that's how you can adjust your withholding. And you can also have an additional amount withheld other than just the regular dependents that you claim. And this is the W-4 form that you use when you fill out and list your, put your name and address and total number of allowances you were claiming would go on line 5. I know many of you can't see that, but when you were working, this is the W-4 that they give you that you have to fill out. It's mandatory to include this in your packet. So some of the examples, W-4 examples, are you can be a single taxpayer with no dependents, no itemized deductions, and gross income of $35,000. So in the new tax law, who does it affect? People who have itemized taxes in the past, have a 2-wage earning household, have a complex tax situation, a large amount of other taxes with large amount of income with no other taxes withheld. You receive a pension or you receive Social Security. So last year, about this time, many of you who may have a pension, a private pension, not Social Security, might have noticed that there was a difference in the withholding. So you got more money each week or each month in your pension than you did in the previous year. But what happens is, if they didn't withhold enough, when you come to file taxes coming this year, you may not get as much back. And everybody is thinking that they're going to get a larger refund because of the new tax law, but that's not necessarily true. So when you file your taxes this season, don't be surprised if the refund isn't quite the same as it was last year. It may or may not be. It all depends on your individual situation. And one way that you can help that is if you get a Social Security, you may want to have federal tax withheld from your Social Security. Most people don't do that because they're usually not in a tax bracket where they're getting taxed on their other income. But I have seen some people who do that, and then they just end up getting it back because they don't owe any taxes. So we'll look at that when you come in if you are having federal taxes withheld from your Social Security that you don't need to. So the new tax law has adjusted the tax tables a little bit. So in 2017 filing season, when it was 10% tax, in 2018, in the next 7 years, it's still going to be a 10% tax, but the levels of income have been adjusted, where they've changed the amount that it'll affect. And then in the 15% tax bracket, which in 17 is now going to be taxed at the rate of 12%. So there's that 3% reduction that everybody thinks they're going to get more money back. But if they haven't withheld enough, it's not going to make any difference, or it may not make any difference. And then if you're in the 25% tax bracket, that has also been reduced by 3% to 22%. So again, everybody's situation is different depending on your income and depending on how much money they've had withheld. This is one of the biggest changes in the new tax law, is the standard deduction. The standard deduction in 2017 for the individual used to be $6,350. So if you were doing your taxes as an individual and you didn't have itemized deductions that would exceeds 6,350, you would automatically get the 6,350. If you had $10,000 worth of deductions, the standard deductions, your deductions would have been 10,000. So the new tax law has changed the 6,350 for an individual to 12,000. So that means that an individual coming in doesn't exceed $12,000, they're automatically going to get $12,000 as a standard deduction, which would come right off of your gross income. But what they did was, and I think it's another slide later on, is that took away the exemptions of $4,050. So they've kind of combined the exemptions in with the standard deduction. So for the 2018 tax season, standard deduction for an individual is $12,000. That's every individual will get that. For head of household, it's $18,000 when it used to be $9,350. So they've essentially almost doubled the standard deduction from what it was up through 17 to 2018. And then if you're married filing jointly, the standard deduction is $24,000, where it used to be $12,700. So a husband and wife coming in, that you would have, if you were joint return, in years past, you would have had $12,700 standard deduction, which would reduce your adjusted gross income.
I have a question. Now, will we still be able to deduct our loan payment on property taxes and that, or are they phasing that out?
Your real estate taxes, as part of your standardized deduction, it's not going to make any difference. Do you file joint? Okay. So you're automatically going to get at least $24,000. So my guess is you don't have more than $24,000 worth of deductions. But that would be the norm. We don't even think we're going to see anybody this year that's going to have more than 24. And if you're 65 and over, each one will get an additional $1,300 as on the standardized deduction. So instead of, if you're under 65, filing joint return, it's $24,000, and I'm going to say the chief would probably be under 65. Files married filing jointly. You don't have to say it, you get whatever. $24,000 automatic. So if he has more than $24,000, he'll have to do an itemized return. If he has up to $24,000, he doesn't have to itemize. So that's going to reduce the time that everybody's going to have to take to itemize. We don't think, like I said, we don't think we're going to see anybody who's going to be itemizing. I've never seen anybody over $21,000 that I've done in the last 5 years. So under 65, married filing jointly, the standard deduction is $24,000. If both taxpayers married filing jointly are 65 and over, it's $26,600. You get an additional $2,600 each, $1,300 each. So total of $2,600. So that would be $26,600 for standardized deduction at 65 and over. And I would bet dollars to donuts nobody's going to be doing that in this area. So that's the big aspect of what the new tax law has done. It should make filing a little bit easier. So what the new tax law does, it eliminates the personal exemptions. So before the tax law, you were able to take $4,150 from income for each person claimed. So if you had a husband and wife and had 3 kids, they would get the $4,150 for the husband and wife, and then they get $4,150 for each of the kids. 5 times whatever that is 20-something thousand. So because there's no more exemptions, if there's a large family with 4 or 5 kids, some of those kids aren't going to they won't be able to take the $4,150 for those kids because of the standardized deduction, where the exemptions are rolled into the standardized deduction. And like I said before, this will eliminate most itemized deductions. So it theoretically makes the tax filing simpler, but we'll see. If One other big aspect of the tax law is alimony. When somebody was paying alimony, they could deduct it. It used to go on the bottom of the first page on the tax return. That's no longer applied, no longer applicable. And those who are receiving alimony do not have to report it anymore. And those changes begin in the 2019 tax season for divorces that are signed in 18. The other thing it does, it limits the deduction on the mortgage interest to the first $750,000 of the loan. So if you have $1 million loan, $250,000 of that loan, the interest on $250,000 cannot be deducted. And one of the other things that people used to do is get a home equity loan, and you were able to deduct the interest on the home equity loan. No longer can do that unless the loan is used for construction of your main home. And it also increases the deduction for medical expenses for 2017 and 2018, and it also repeals the Obama tax where you were on the old Affordable Care Act. If you didn't have insurance, you had to pay that tax. That's going to go away after this year, unless they change the law. So, if you're filing a joint return when you come in, please bring a valid ID, photo ID. And we like to look at we always look at those, and we always like to make sure your license or your ID is still valid, is still current. And also bring in your Social Security card so we can verify your number, along with a government photo ID, which can be a license or a passport. If you can't find your Social Security card, it's okay to bring in your Social Security statement, the statement that you might have just gotten in the last week or so. You can bring that in. You also would need any income, W-2s, Social Security statements, any pension statements, bank interest, and dividends. Anything that says 1099 on it, that's going to be your 1099-R, your 1099-INT for interest, 1099 DIV for dividends, 1099-B for brokerage, any brokerage statements. Some of you people may have stocks that get bought and sold for you. So we need all the 1099, the income statements. Then many of you are eligible or could be eligible for the senior circuit breaker. In order to be eligible for the credit, you need to be 65 or older by the December 31st of the preceding of the tax year. So you have to be 65 or older by December 31st of 2018. And you need to file a mass return in order to receive the credit, which makes sense. Massachusetts property must be owned, rented, or occupied as your primary home. And your income, there are income limits on the senior circuit breaker. Somebody filing single can't have more than $58,000 in income. Head of household is $73,000. Married filing joint return is $88,000. If you're married filing separately, you're not eligible for the credit. Has to be single, head of household, or married filing jointly. So what we look at is we look at the Massachusetts property tax that you pay in your main home for residences that are on land an acre or smaller. If it's larger than an acre, we are supposed to prorate it. So you take your property tax plus half of your water and sewer expenses, town water and sewer, and that expense must exceed 10% of your total Massachusetts adjusted gross income. So when you look at your federal adjusted gross income, they don't count Social Security in your federal adjusted gross income, because Social Security income is only taxable when you exceed a certain amount of other income. In Massachusetts, we look at everything. We look at your pension, we look at your Social Security, we look at your interest, all of your income. So take your property tax plus half the water sewer must exceed 10% of the Massachusetts income for the year. So Massachusetts adjusted gross income, as an example, is $31,000. 10% of $31,000 is $3,100. Real estate taxes that you paid in the calendar year for 2018 for your primary residence, for example, could be $4,875. The difference between $4,875 and $3,100 is $1,775. The max senior circuit breaker credit is $1,100. $1,775 is greater than the $1,100. Therefore, you'll get the $1,100 as a senior circuit breaker credit. Renters of public housing or with subsidized rental agreements are not eligible for this because you're already getting a break on your rent. And then other documents that you might need when you come tax time, you might need child care expenses, home mortgage expenses, real estate taxes, tuition statements, business expenses. Let me just go back to the senior circuit breaker. When you bring in your real estate taxes for the senior circuit breaker, bring in the statements paid that you actually paid in the year of 2018. We don't look at what's billed, sometimes because they're billed in quarterly and fiscal years overlap. We need to know what you actually paid for that year. And then we also, if you're going to do direct deposit, bring in your checkbook. You don't need to write void on it. All we're looking for is the routing number and the account number. If you have filed taxes with us before and you know what they are and you didn't bring it in and we can verify it, we'll have you initial the return before we e-file it for you. Any questions? I have a question. What's the standard deduction for married filing jointly, the new standard deduction? Say again? 24,000. What is it for if it's two seniors 65 and over?
497.
1,300 apiece, 2,600 additional. 24,000 and 26,600 is 2,600. 24,000 and 2,600 is 26,600. Do you have a computer? Do you have a computer? Do you have a wireless mouse?
Oh, no, I don't have a computer with, no.
Okay. Any questions? Concerns? Confusion? Pardon me? Question is, so the question is, the general question is, I'm elderly. I don't have to file. Is that true? What determines you have to file? Your income. Age has nothing to do with it. You could be 95 years old and have billions of dollars in interest or whatever, you'd have to file. It's income, not age. Question.
Will our refunders be impacted, going to get them in time this year, or?
That's a good question. Last Friday, I actually had to email an IRS. We have people who work with us who work for the IRS who are liaisons for us with us. And I had a question, and I sent him an email, and he ended up responding on Monday. And I actually called him, talked to him on Monday. He had just gotten back to work after 5 weeks. So they're not too happy, but it seems to be that they think everything will be okay, at least for a few weeks. We'll see what happens in a couple more weeks, but I don't know. That's the word, is that the IRS is working. So, and my other tax preparers, Tim Brady, who will be here on Monday. He comes here on Mondays to prepare. He is not related to Tom Brady, and he actually he prepared returns this morning in Grafton, and he told me he didn't have any problems. Everything went well, so we're hoping that continue. So Monday will be the first day here. So anything else? Thank you. Yes. Yeah. The chief had a question. Do we file electronically? Yes, we do. We prefer it. We don't like to do paper returns because it's a pain in the neck. That means we have to print the return, an extra return for you, and you have to mail it. But we are pretty successful e-filing it all electronically. Okay.
Thank you very much. That was Steve Lotterman, not Lotteryman, Steve Lotterman. Thank you all. Thank you for giving us a little lecture. Can we have a little round of applause for our guest speaker? Thank you very much. And we'll plan to see you next month.